Well, good day, everyone, and welcome to this Kaplan webinar on corporate capitalization using equity securities. My name is Brad Charles, and I'll be your instructor for this course, which is a 1-hour webinar. I'm sort of the utility infielder here at Kaplan. For securities classes, I teach the Series 7, the Series 6, the Series 63, the Series 65, the Series 66, and the SIE exam. And I also teach pre-licensing classes for life and health insurance and property and casualty insurance, as well as continuing education classes for insurance. I travel a lot for my job, so my wife says I need a name tag when I come home. But today, due to the coronavirus emergency, I am coming to you from my home here in Milwaukee, Wisconsin, where it's a balmy 43 degrees with a little snow in the air. We call that springtime here in Wisconsin. This webinar is the second in a series of 12 webinars over the month of April on topics common to all securities tests. For a list of classes and times, please contact Kaplan to get the latest updates. Due to the number of participants on this call, I will not be able to answer questions as we go through the material. So instead, my good friend Mark Esposito will be your moderator for this class. Mark is one of our senior instructors, so he will be able to help you with whatever you need. We do ask that you limit your questions to the material in this particular class, though. For questions regarding other topics, we recommend you attend a future seminar on that particular subject. So, shall we begin? At Kaplan, our job is to help you prepare for your test, help you practice for it, and also to perform at your highest level on the day of the test. It's your job to pass the test, and it's our job to help you pass the test the first time. So that's kind of our motto at Kaplan. We want to try to help you with that and help you perform at your best on the day of your test. Today, we're going to be talking about corporate capitalization using equity securities. Capitalization is the process a corporation goes through to raise money. Why do they need to raise money? Well, they might be expanding their business. You need money to do that. They might be borrowing, buying another company. You need money to do that. They might be merging with another company. You need that, money to do that. Or they might be an initial startup company that was private and now it's going to go public, so everybody in America can have a piece of ownership in it. That's another reason why they might need to raise money. So that's capitalization. There are two ways a corporation can raise money. One way is using equity securities. This is where they sell pieces of ownership to investors and then use that money for the sale of those securities for whatever purpose the corporation needs. That's equity securities. But the other way they can raise money with capitalization is to borrow the money from investors. In this case, they would issue debt securities. Debt securities is actually our next webinar in our series of 12 here. So I will be doing that one as well. So stay tuned for that one. And we'll go ahead and talk about debt securities in the next webinar. After this webinar, you should be able to distinguish between the various types of equity securities, identify the characteristics of common stock and preferred stock, and then recognize the risks of owning equity securities. All investments have risk. And basically it works like this. The more potential reward for you as an investor, the more risk you're going to have to take to get that potential reward. And equity securities have great potential for reward, but they also have great risk. And we will talk about that towards the end of our webinar here. There are two types of equity securities out there in the marketplace. We have common stock of corporations, and we have preferred stock of corporations. Common stock is the most common type of stock out there in the marketplace. That's why they call it common stock. All corporations sell common stock. Not all corporations sell preferred stock. They can, but they don't have to. And we will see that the investors of preferred stock are going to be preferred over the common stockholders in different ways. And that's why they call it preferred stock. It has preference over the common stockholders of the corporation. So let's start off with common stock first, and then we'll talk about preferred stock. Common stock represents ownership in a company. So if you own stock in a corporation, you are a part owner in that corporation. Now, you probably know that in the National Football League, the only team that is not owned by an egomaniacal owner is the Green Bay Packers, our team here in Wisconsin. They're owned by the people. So you too can own a piece of the Green Bay Packers. Now, they don't let you own very much because they only let you buy 200 shares. That might be the chin strap of Aaron Rodgers, maybe the shoelace of Davante Adams. You can't own very much. And actually, if you own stock in the Green Bay Packers, you don't have any rights at all. You get a certificate, stock certificate that you put in a nice frame. You put it on your mantle of your fireplace and say, I'm an owner of the Green Bay Packers. But that's all you get. You don't get any rights other than owning the stock itself. As an owner of a corporation, you are going to have certain rights. One of the rights you have is to inspect the books and records of the corporation to make sure they're not cooking the books. Now, they will send you an annual statement. It's essentially like a slick marketing piece the corporation sends out to you. It's kind of rosy, makes everything look great, you know, but it's not as in-depth as maybe an investor might need. So you can certainly ask for more information from the corporation because you are an owner. You have the right to inspect the books and records of that corporation. You also have the ability to vote for things. The board of directors is the executive team that makes the big decisions of a corporation. They decide how much money to pay out to people each year. They decide, you know, what companies we're going to buy and what our upper management is going to be. They hire all those people. They make the big decisions. So the board of directors making the big decisions, sometimes they come to you as a common stockholder for a big decision. Like, for example, if they're going to convert one type of stock into another type of stock, they'd have to have a majority of the shareholders agree to that. If they're going to do a really big stock dividend, like over 25% stock dividend, probably going to have a majority of the stockholders agree to that. And if they're going to buy another company or merge with another company, they would also come to the common stockholders in a vote for that as well to get the majority of them to agree to that. But probably the most important vote you have as a common stockholder is the ability to vote the board of directors in and vote them out. Every couple of years, they have a political election, similar to you would see with politicians, where you get to vote for the board of directors, vote people in, vote people out. And we're going to go through that process in a couple of minutes so you can see the two types of methods that companies can use for voting. But that's a very important right that you have as a common stockholder, the right to vote the board of directors in and vote them out every couple of years. Essentially what that's called is democracy rights. So you do have democracy rights over the board of directors. Transfer of ownership is also a very important right. Transfer of ownership essentially allows you to sell the stock. Common stock is very, very liquid out there in the marketplace. Liquid means it's easy to sell it and turn it into cash. A lot of our stocks trade on exchanges, very, very liquid at an exchange. And then we also have the over-the-counter market where broker-dealers bring buyers and sellers together and work with stocks that are not on exchanges. Again, That's very liquid out there, very easy to buy and sell your security. So liquidity, transfer of ownership, is also a very important right that you would have as a common stockholder. You also have a claim on the assets of a corporation if they go bankrupt. That's called liquidation. Liquidation is where they sell other assets and they go out of business. You have a claim on those assets. However, you are actually the low person on the totem pole for that. Low person on the totem pole. You're the last person to get your money if the company goes bankrupt. And theoretically, you can lose everything if you invest in a common stock, because the company doesn't owe stockholders anything if the corporation goes bankrupt. You have all the risk if you're a stockholder. Every dime of your money is at risk when you have common stock that you own in a corporation. And you're the last people to get your money if a company is liquidated. You might not get any of your money back because they don't owe you a dime in a bankruptcy. You also have limited liability. Limited liability means you can't lose anything more than you paid for the stock. Maybe you paid $5,000 for the stock, the company goes bankrupt, they go into liquidation. You can't lose anything more than the $5,000 you paid. You might lose it all, but you can't lose any more than the $5,000. Another name for that is non-assessable. Non-assessable means you can't lose anything more than you paid for it. Years ago, they sold assessable stock, where you could lose more than you paid for it in a bankruptcy, and theoretically, you could lose infinity if you owned assessable stock. They really don't sell that kind of stock anymore today. So the type of stock we sell today is the non-assessable stock, where the common stockholder would have limited liability. They can't lose anything more than they paid for it. Now, when a corporation does voting, there are two different methods they can use, and you would find this in the company charter of the corporation. That's one of the founding documents that creates a corporation. They file those documents with their state of domicile. That's the state that they become a corporation. You would see it in those documents. It would tell you how the voting is actually done. Let's say we have an investor here who owns 100 shares of BFC Incorporated, a corporation, 100 shares. Now, you get 1 vote for every share you got, so that means you would have 100 votes. Let's say that we have a board of directors that has a board of 5 different people, and we have 3 seats that are open. Those are the seats that you're voting for. Just the 3, not all 5, just the 3. So we have 3 seats that are open. What you'll have here in the statutory voting is 100 votes per seat, because statutory voting is a per seat vote. So you'd have 100 votes on the first seat that's open, 100 votes on the second seat that's open, and 100 votes on the third seat that is open. Now, this type of voting method is going to favor larger investors, the ones that have a larger number of shares, because they're going to have more votes per seat. Let's say we have another investor who has 1,000 shares of BFC Incorporated. Well, now they have 1,000 votes on the first open seat, 1,000 votes on the second open seat, 1,000 votes on the third open seat. Who's got more clout in the election? The larger investor. They have more votes because they have more shares. So that is the per seat vote. It is going to favor the larger investors. But then we might have another company here. The company, we'll call this one CES Incorporated. We have an investor that owns 100 shares in this company, but this company also has the 5 board members for the board of directors. We do have 3 seats that are open here on the board of directors that you'll be voting for, but this company uses the cumulative voting method. Now, the cumulative voting method, it's not a per seat vote. What we do is we take the number of shares you have and multiply it times the number of open seats. Well, this person has 100 shares. multiply that times 3 open seats, and we have 300 votes to work with. Now you can use those votes any way you wish, any way you wish. You could go 150 votes on one seat, 0 votes on another seat, 150 votes on another seat. You could do 250, 50, and 0. You could do 100, 100, and 100, you know, just like statutory voting if you want to. Or what you could do is you could take all 300 of your votes, just put them on one seat and concentrate your votes on that seat to try to vote that board of director in or vote them out. That's what the smaller investors can do in the cumulative voting. They can concentrate their votes on certain seats that are open on the board of directors. So that's going to favor the people that have the fewer shares, the people that have less shares. So this one favors the smaller investor. Cumulative voting favors the smaller investor, where statutory voting favors the larger investor. Now, with cumulative voting, you have to be careful here, because what they usually do on the test is they give you the number of candidates that are running for the 3 seats. Maybe there's 5 candidates running for these 3 seats. You don't take the 5 candidates and multiply that times your 100 shares. You'll get 500 votes that way, and that will be an incorrect answer. Do not do that. Take your 100 shares, or whatever they give your number of shares, multiply it times the seats that are open on the board, not the candidates, and you get the correct number of votes to work with. And again, you can use them any way that you want to. Right now, the average failing score in a securities test is a 68. Man, 68. You get a 68, you're right there, but you didn't quite pass. So one of the things we try to do as captain instructors is make sure you don't get a 68. And we know all the ways they try to trick you and deceive you and mess up your mind on the test. This is one of them. They'll give you those 5 candidates and try to pull you into that answer. Do not pick candidates. Take the number of open seats, multiply times the number of shares you have, and that's how many votes you have to work with for the cumulative voting. If you use the 5 candidates or whatever they give you candidates, believe me, there'll be an answer for you. Great way to get a 68. So what are the benefits of owning common stock in a corporation? Well, I think the main reason people buy common stock is for growth purposes. It's the growth product, because historically, it's really the only investment that's consistently beaten the inflation rate over the years. The inflation rate is essentially the cost of living, prices going up over time. Well, your real rate of return on your investment is going to be the rate of return on your investment minus the inflation rate. So it's your annual rate of return minus your annual inflation rate from the government. That's what your real rate of return is. Well, the common stock over the years has clobbered the inflation rate. So that is going to be the growth product. I just did an analysis of the S&P 500 here over the last 6 years before we had this terrible downturn with the coronavirus. And I took a look at it, and it had an average of 11% a year. Now, the inflation rate, you probably know, has been very, very low the last several years. It's averaged actually around 2%. So 11% minus 2% is 9%. That would be your real rate of return per year over that 6-year period. So that's a really good rate of return for you. It helps people reach their goals of what they're trying to do for their future growth of their money. The other reason that people can buy common stock is for income purposes. The income you receive from common stock is called the dividend. The dividend is paid out by the board of directors each year from the earnings of the corporation. The earnings of a corporation is sometimes called net income. It's the income of the company for the year minus their expenses, minus the taxes they pay on that. What's left over is the net income of the company, and then the board of directors decides how much to pay out of that earnings to the stockholders in a dividend. So one of the advantages of owning common stock is you can get income from it. Now, some common stock really doesn't pay dividends to you. Those are called growth stocks. Growth stocks are designed for the price of the stock to grow over time, so you can buy it low today, sell it high in the future, many years down the road, and make a fortune when you sell it. That's called a capital gain. Those companies really don't pay out a lot of dividends because they take all the earnings that they make each year and they drive it into the company and try to grow the company. That's essentially what a growth stock is. If they grow the company, people start buying that stock, it drives the price up over the years, and that's essentially what a growth stock is. But then we have, larger companies that have been around a long time. They really aren't trying to grow the company anymore. They pay nice dividends to people. So those are good income producers if someone's looking for income, assuming that they're paying cash dividends. Cash dividends is, of course, where they're going to pay cash. Years ago, they used to mail out a check to you for your dividend. Dividends are paid quarterly. So what happens is the board of directors announces them annually once a year, and then they pay the dividend out every 3 months, 1/4 of it every 3 months over that year. So you actually get 4 dividend payments because they take the dividend for the year divided by 4, and you get that every 3 months. Let's say the cash dividend this year is $4 a share. You'd get $1 a share every 3 months. So it's a good income producer for some companies. Some companies are good income producers. One of those would be utility stocks. Utility stocks pay a boatload of dividends over the years. So they're really good income producers for folks if they're looking for income. Another thing a company can do is they can pay a stock dividend to you instead of a cash dividend. With a stock dividend, they're going to give you extra stock every 3 months. So they have an annual stock dividend they're going to pay, and then every 3 months they pay a quarter of that to you in a stock dividend. So stock dividends would be paid out by companies, probably companies that are smaller, who really don't have the money, the cash to be able to pay out cash dividends. So they pay you a stock dividend instead. Also, research and development companies. They have to have a lot of cash in order to do research and development on different processes and pharmaceuticals and things like that. They normally pay stock dividends to you, not cash dividends. Now, they might give you a question on the test like this: who would prefer a cash dividend and who would prefer a stock dividend? Well, if someone's looking for income now, income coming in right now, they would prefer a cash dividend. Who would that be? Probably an elderly person in retirement now who's looking to try to get the maximum income they can from their retirement savings. That'd be a good example of someone who's looking for cash dividends. Senior citizens love utility stock because they pay a boatload of dividends. And you probably remember from some of your other reading that dividends are taxed at a lower tax rate than other types of investments for cash dividends. You'd have to hold the stock for 60 days, but if you have the stock for 60 days, you're going to get a lower tax rate on that. So you get a nice income and a lower tax rate. But then if someone is preferring growth of their money over the years, they don't want the company paying out cash. They want the company to keep the cash in the company and use it to grow the company. So those people are probably going to prefer the stock dividends, because what will happen then is that if that stock price continues to grow over the years, they're going to get more and more stock of that corporation, which is going to dramatically increase their growth potential over the years as well. Yield is rate of return. So the dividend yield is going to be the rate of return on your common stock. Sometimes they call it a stock yield, sometimes they call it the current yield, sometimes they call it the dividend yield. They have a lot of names for these things, but we're going to call it the dividend yield here. And for those of you who are finance majors, you know that yield, rate of return, is the annual income from an investment divided by the current price of the investment right now. Annual income divided by the current price. That is rate of return. So your current yield, your dividend yield, is the annual dividend that's declared by the board of directors divided by the current market value of the stock right now. On the test, they use CMV for that, current market value, CMV. Let's say that an investor owns 100 shares of BC Incorporated. The current market value of the stock right now is $20 a share. They would probably use yesterday's closing price for that particular CMV. That's what they normally would use in the marketplace. You wouldn't use the price, you know, if you look it up on your phone right now today, you probably would use yesterday's closing price for that. And they're paying out a 25-cent quarterly dividend. Now, quarterly is not annual. This formula uses the annual dividend, not the quarterly dividend. They'll give you the quarterly dividend because corporations pay dividends quarterly. Normally, they do. So they'll probably give it as a quarterly number. What do you have to multiply quarterly times in order to make it annual? Got to multiply times 4. Wouldn't it be a real shame if you got a 68 because you forgot to multiply times 4 a couple of times on a dividend yield question? So multiply the quarterly dividend they give you times 4 quarters. That gives you the annual dividend of 1 year. Then you divide that by the $20 current market value of the stock, and you'll get 5% as your dividend yield, your current yield. Actually, you can look up the dividend yield of any stock out there in the marketplace in the back of the business section of a newspaper. The business section has all the stocks listed back there, you know. They have many different columns you can look at with stocks in the back of the newspaper. One of those columns is called DIVYLD, dividend yield. Dividend yield. That is the annual dividend declared by the board of directors of that company divided by yesterday's closing price. That's what it is. So you can look up the dividend yield, the current rate of return of any stock you want to out there in the marketplace by just picking up a newspaper. The board of directors is the only organization who can declare dividends. You can't have stockholders declaring dividends each year because they'll, you know, bankrupt the company because they want as much, you know, stock dividend or cash dividend as they can possibly get. So the board of directors is kind of the monitor of that to make sure that they only pay out a certain amount of the earnings of the company each year in dividends. They don't pay all their earnings out each year. If they do that, the company will go broke. So the board of directors declares how much they want to pay out from the earnings of the company in a dividend. They do that on the declaration date. The declaration date is a big announcement day for the board of directors of a corporation. It's a big media day where they bring in the bloggers and the newspaper people and the TV cameras, and they say, here are the earnings of the corporation for the year, and here's the dividend we're going to be paying to our shareholders for the year. So maybe the earnings per share is $4 a share. That's our earnings this year. We could pay out $4, but they're not going to do that. They're going to pay part of that out to you. Maybe they pay you $1. So we have $1 as our dividend payout per year for this year out of the $4 that they could pay. That's called the declaration date. Big announcement day, a big day of pomp and circumstance and hoopla for the board of directors of a corporation. On that day, they will also announce the record date. The record date is the day you have to be an owner. If you don't own the stock on the record date, you are not going to get that dividend. Now, they are going to pay a dividend 3 months down the road. So if you still own the stock 3 months later, you'll get the next dividend, but you won't get this dividend if you aren't the owner on that record date. You have to be an owner on the record date in order to get that dividend. Then we have what's called the payable date. That is also announced by the board of directors on the declaration date. And what that's going to be is the actual day that they pay you either the cash dividend or they pay you the stock dividend. You know, in the old days when they paid out cash dividends, they actually mailed you a check, snail mailed to your house, and you took that and deposited in your checking account or your savings account or whatever you might have at the bank. Today, it's all done, you know, electronically. You probably have like a sweep account at your broker dealer, and they sweep it in there, you know, electronically, and everything's done with computers. But in the old days, it was paper checks that they mailed out to people, snail mail, and then you had to put those in your savings accounts or your checking accounts. The one date that the board of directors does not set is called the ex-dividend date, or sometimes you just call it the X date for short. This is actually the first day that a stock trades without the dividend. So it says that if you buy the stock on the X date, you won't get that dividend. You are buying it without the dividend. X means without. And I'll show you why that is here in a minute. Let's take a look at a calendar where you can see all of these dates in a calendar. And then I'll go back and I'll show you a quick way that you can remember the different types of dates you need to know for stock dividends. The declaration date is the day that the board of directors announces the earnings of the company for the year and the dividend they're going to pay out of the earnings. We're going to make that March 30th. So that'll be our declaration date, the big announcement day by the board of directors. The record date is the day you have to be an owner. They will go ahead and set that date as on the declaration date, and we're going to make that the 24th of April. Then we have the payable date. That is also set by the board of directors on the declaration date, the day they're going to pay you the cash dividend or pay you the stock dividend. We're going to make that May 1st. This is usually spread out over, a couple of months. So we're trying to spread this out so you can see how it might look, in real life out there. Then we said that the one date that the board of directors does not set is called the ex-dividend date. That date is actually set by the exchange if your stock is on a stock exchange, or it's set by FINRA. FINRA is the Financial Industry Regulatory Authority. They're the big brother in our industry to make sure you do everything properly out there. They're also the people that write the test questions for you. They will set the X date if your stock is not on an exchange. But whoever sets it, whether it's the exchange that sets it or the FINRA that sets it, it will be set one business day in front of the record date. Now, why did they do that? Well, it's because stocks trade regular way T+2. T+2. What that means is if you bought a stock on April 23rd there, Thursday, you won't be an owner for 2 business days because that's when you have to settle the contract. That's when you have to make settlement. That's when you pay for it. And that's when the seller would cough up the certificates for you. So you'd be giving them money and they'd be giving you the certificates. So that would actually be on Monday, April 27th would be the settlement date. So let's say the trade date is the 23rd. That's the day the buyer and the seller decide to do this trade. They agree on a price. The buyer is not going to pay for it for 2 business days, which is actually Monday the 27th, which means if they did buy the stock on the 23rd, the trade date is the day they buy the stock, they're not an owner until the 27th, because that's the settlement date, so they will not get that dividend because they were not an owner on the record date, which is the 24th. So really the X date is the first day someone could buy a stock in the marketplace and not get the dividend, because it's going to be 2 days before they become the true owner of that stock, and they will not be on the record date, so they're buying it ex-dividend. If they hang on to the stock for 3 more months, they'll be able to get the next dividend when it comes around because they pay dividends every 3 months, but they won't get that first one if they buy it on the X date. Now, one of the things they might ask you about is called selling dividends. Selling dividends is a big violation at FINRA. I had a student ask me one time, they said, well, Mr. Charles, if people can't get the dividend when they buy it on the X date, why don't we just sell stocks right in front of X dates? Because if we do that, we sell it to them on the 22nd, Wednesday the 22nd, they'll be an owner 2 days later, and on the record date, they will be an owner. And that's called selling dividends, and that is illegal. You will be written up for that. And I worked for MetLife Securities for 17 of my 20 years in the business. And if you got written up 3 times at MetLife, you were gone. They'd ask you, they would fire you. So selling dividends is a big, big no-no at FINRA. So make sure you stay away from that answer, because you don't want to be selling dividends to people. You can get a lot of trouble for that. Kaplan likes to help use what are called acronyms to help you remember things. Acronyms are a series of letters to help you remember different types of concepts you need to know in the test. We use DERP for this one, D-E-R-P. The D is the declaration date, the E is the X dividend date, DR is the record date, and P is the payable date. So that's DIRP. So you can remember the dates for common stock dividends using DIRP. Doesn't matter how you remember this stuff, as long as you remember it for the length of time you have to take the test, and then you can forget everything after that. But that day, you remember some of these things by some of these acronyms and little tricks that we have at Kaplan to help you remember concepts on the test. So with every investment, we have risk. I call risk the dark side of the force. If you're a Star Wars fan, you know what that's all about. You have to tell people about the risks. Every investment has risks. And the more reward potentially you can make from this investment, the more risk you have to take in order to get that potential reward. So what are the risks of common stock ownership? Price fluctuation. That's where the price of your stock is bouncing around all over the place. It's going up, it's going down, it's going up and going down. The marketplace dictates what the price of a stock is going to be over time. It's good old supply and demand. If there are more people buying it today than selling it, the price goes up. If there's more people selling it today than buying it, it's going down. So even throughout the trading day, you'll see the stock price moving around all day long. And then over time, over weeks and over months, it can change dramatically up and down over time. So if you have someone who really doesn't like that, really doesn't like the price fluctuation, you need to have them do some other types of things with their portfolio investments to try to mitigate some of that. Because if they're just investing in stocks, this is not for the faint of heart. This is going to be a situation where the value of their investments is going to be bouncing around all over the place. And if they don't like that, you need to do some things to help them mitigate some of that price fluctuation. The other thing is with common stock is if a company goes bankrupt, they don't owe you a dime. If you paid $5,000 for that stock, you can lose everything in your investment. Whatever it's worth today, it can go to zero and you can have nothing. Just ask the people that work for Enron. Did you know there were people that work for Enron Corporation who had 100% of their 401k money in Enron stock? Enron stock went to zero in 12 months, and those people lost their entire life savings by investing in one stock. So one of the things we talk a lot about in some of our other classes is diversification. Diversifying people into different types of investments, different types of asset classes, different types of industries to prevent them from being locked into one investment where they could lose everything. So yeah, you can lose everything with common stock. With great reward comes great risk. So we have to make sure people understand that in terms of risk. I will tell you though, some stocks are riskier than others. You could have what's called a large cap stock. A large cap stock would be a company that's been around a long time. They're a huge company, huge organization. They have less fluctuation in their prices of their stock over time. But a small cap company, that's a small organization, small corporation, they have tremendous growth potential, but tremendous price fluctuation. So you're going to have a lot more risk in terms of price fluctuation for a small cap stock than you would for a large cap stock. And then we have what are called the mid cap stocks. Those are the medium sized companies out there. So you're looking at medium risk and medium reward with those types of stocks. Capitalization is how big a company is. It is when we talk about size, it's the share price, their share price times the number of shares they've got. So if they're a really big company, big capitalization, they're going to be safer than a little company that has a smaller capitalization. So that's everything you need to know about common stock. Let's talk about preferred stock. Preferred stock is the other type of stock a corporation can sell. They don't have to sell preferred stock if they don't want to. They don't have to, they don't want to, but a lot of companies do. And if you own preferred stock, you are preferred over the common stockholders of the corporation. That's why they call it preferred stock. They like you better. They like you better. And they like you better in two ways. One way is when the company liquidates, that means that they're going to go bankrupt, they owe you money first before they owe the common stockholders any money. So you have preference over them in liquidation. Now, the company doesn't owe you anything in a bankruptcy because you are a stockholder, but if they have the money to do it, they'll pay you money before they pay anything to the common stockholders in a liquidation. That's bankruptcy. The other preference you have is with dividends. They have to pay you your dividend first before they pay dividends to the common stockholders. They might not pay anything to the common stockholders, and they'll pay you money first. So you have preference over them with dividends. So you have preference with dividends and also preference with liquidation. Really, the only downside of owning preferred stock, besides the fact that you can lose everything, is you don't have voting rights. And there are some rare occasions why you'd be able to you have to have voting rights. You would be able to get voting rights, but on most of our securities tests, that would not be true. So I would say the one downside of preferred stock on most of our securities tests is the fact that you don't have voting rights. They're not going to come to you to vote for things like you can't vote for the board of directors, you can't vote for different types of things. The board of directors comes to the common shareholders for those types of votes normally. So we have different types of preferred stock. There's quite a few different kinds actually, but we do have straight preferred and we have cumulative preferred. Those are probably the two most common ones out there. Straight preferred is where you're just going to get the current dividend that is declared by the board of directors for the year. That's all you're going to get. If they do miss dividends in some years, you're not going to get caught up. Now, do companies miss dividends sometimes where they don't pay out dividends to people or they pay less than they thought they were going to? Yes, it happens all the time, especially in recessions. You get a terrible recession, they miss their dividends. You're not going to get the dividend this year. And then next year, when they pay out dividends, they are not going to go back and catch you up. You're just going to get the dividend of whatever declared for that year. Sometimes they call that non-cumulative preferred. So non-cumulative preferred, straight preferred is where you're just going to get the current dividend for the year. You're not going to get caught up in any past dividends that were missed. With cumulative preferred, those are the ones that are going to pay you the past dividends they owe you first, and then they pay the current dividend that they're paying out on that stock in addition to that. So this is the stock where they're going to go back and catch you up first. Those are called dividends in arrears. Dividends that they owe to the cumulative preferred stockholders have to be paid out before they pay dividends to any of the other preferred stockholders. Now, all companies don't sell cumulative preferred, but if they do, that's the way it would work. Let's look at the preferred stock itself. The preferred stock has a par value of $100. Now, the par value has nothing to do with the market value of the stock in the marketplace. It's an arbitrary number they use to put on the balance sheet of a corporation. That's a snapshot of what a company looks like. They put on the balance sheet that particular day when they create the balance sheet. They use the $100 par value. They multiply that times the number of shares they got. They put that on the balance sheet. We also use this figure, the par value, to calculate how much dividend you're going to get from this preferred stock. So you'll get a question to be like, we have a 6% preferred stock with a par value of $100. What is the annual dividend that's going to pay you? What you do is you take the 6%, multiply times $100, and you get the annual dividend of $6 a year. Now remember, they pay dividends quarterly, so you got to take the $6, divide it by 4, and that means they're going to pay out $1.50 every 3 months to you per share on that preferred stock. Now, there is preferred stock out that's $200 par. There's some that's $500 par. We think on the test they're going to use 100 because it's the most typical one you see out there. But if it does have a par value different than $100, what they do is they just give you the dollar amount for the year. They'll just give you the $6 annual dividend. They call it $6 preferred. So $6 preferred, 6% preferred, that'd be the same thing. You're going to get $6 per share per year. Divide that by 4 and you'll get the $1.50 per quarter. Now, let's say we've got a 6% non-cumulative preferred. It's going to pay you 6% per year. Again, that's $6 because we're using the $100 par value. And they'll give you an example like this where they have a company over several years and they'll show you what happened in the past and what they're going to do for you this year. Let's say back in 2017, they only paid $2 out of the 6 because they had a bad earnings year. That means they missed $4. Then in 2018, they paid $3, which means they missed $3 per share. Now it's 2019. What will the non-cumulative preferred shareholder receive? All they're going to get is the $6. It does not go back and catch you up on the ones that they missed. It just pays out what the current dividend is this year with the dividend for this particular stock, which is the 6%. By the way, the 6% does not change. It's the same all the time. So that preferred stock is going to be a really good income producer, people looking for consistent income, because they should be getting that $6 per share every year. If they miss dividends, a corporation miss dividends, you don't get caught up with the non-cumulative preferred. With the cumulative preferred, you will get caught up. They go back and take a look at the ones they missed, and if they have enough money to do it, they'll go ahead and pay those dividends in arrears to you, and then they'll go ahead and pay the current dividend for the year as well. Now, is that a benefit to you? Yes, that definitely is. Well, corporations don't give you something for nothing. So this is going to have a lower dividend rate on it than their regular old non-cumulative straight preferred. So we're using 5% here for the cumulative preferred. Definitely going to have a lower dividend rate per year, which means they're only going to pay you $5 a year, because you have the benefit of being caught up in years when they miss dividends. So let's say in 2017, they pay you $1 per share, they missed $4. Then in 2018, they paid $3 per share. You can see that they missed $2 because they were supposed to pay you the $5 a share on this cumulative preferred. What are they going to pay you now in 2019? Well, they have enough money to do it. They have enough earnings to do it. They'll go ahead and pay you the $6 that they owe from the $4 and the $2 they missed, plus the $5 they owe you this year, and you'll get $11 per share. That's a nice year for you. But like I said, they don't do that for free. Corporations don't do anything for free. If they give you a benefit of some kind, you're going to have a lower income coming in from that investment. So this would have a lower income coming in per year. But the customer knows that. They know they're not going to get as much as the non-cumulative stockholders are going to get each year, but they also know that corporations miss dividends sometimes. And when they miss dividends, they'll be able to get caught up with dividends in arrears. One of the questions you might see on the test is, what order do they pay dividends? They have to pay dividends in arrears to the cumulative preferred people first. Then they pay the preferred dividend out to all preferred stockholders, including the cumulative people. And then they pay the common stockholder dividend last. So you'll probably get a question on that, putting the order of how the company actually does pay dividends. Another type of preferred a lot of companies sell is the convertible preferred. Now, this isn't a convertible like a convertible, driving a car. This is convertible stock that you convert into the common stock of the corporation. You can convert from the convertible preferred into the common stock of that corporation. Now, why would somebody want to do that? Well, their investment objective right now might be income. Preferred stock is a great income producer. It pays dividends every 3 months here like clockwork. Really good income producer. But maybe their investment objective changes, and now they're looking for growth. Well, common stock is the growth product, so maybe someone would convert, for that purpose. I had a friend of mine, good friend actually, who lost his job during the Great Recession. He worked for Mercury Outboard up in Fond du Lac, Wisconsin, had a great job up there, doing really well. Recession hit, he loses his job. And I remember that he had like $250,000 of stock with some I was from his grandfather or his uncle had, given it to him as an inheritance. And so he needed income. So what he could do is he could buy convertible preferred stock with that money. He could take that money and buy convertible preferred. Now he's got that good income producer coming in for him. And then he knew eventually he was going to get a job and get back to work, But in the meantime, he'd get the income coming in to help support his family. His wife was actually a pharmacist, so she had a good income as well, but he wanted to support his family by having income. I'm pretty sure he bought convertible preferred because he knew he was going to go back to growth eventually once he got, as his investment objective, once he found a new job. He actually did find a new job, it was almost a year later. He went into the real estate industry, and he's a real estate agent now. So I'm assuming he's converted that convertible preferred now into common stock, and now it's a growth product for him because he's looking to grow his money, for the future for his retirement savings. So convertible preferred is going to have a $100 par value. Almost all the questions and securities tests use preferred as $100 par. What we need to do is we need to calculate the conversion ratio. The conversion ratio is the number of shares of common stock you'll be able to convert into for every one preferred stock that you have. So what we do is we take the $100 par value, divide by the conversion price that's on your stock certificate. That's the price you're going to receive the common stock at when you convert. That'll be the price you receive it at. You divide that into the $100 par value and you get the conversion ratio. That'll be the number of shares of common stock that you will receive. So we take the $100 par value, divide by the conversion price. They will give you that. They'll give you that conversion price. Let's say that's $25 a share for the common stock. You divide that into the $100, and in this case, you'll get 4 shares of common stock. Now, they usually don't say conversion ratio like 4 to 1, like 4 with a colon and a 1. They usually just ask you, how many shares could you convert into in this of common stock? For every 1 share preferred stock, it's 4. Now, is this a benefit to you to be able to convert from the preferred stock of a corporation into the common stock of that corporation? By the way, it has to be the same corporation. Is that a benefit to you? Yes. Well, they're not going to do that for free. So what do you think? Would this dividend rate per year on convertible preferred be higher or lower than their straight preferred, the regular non-cumulative preferred? It's lower. It might be 5.5%. It might be 5.75%. It's going to be lower than the 6% that they're paying on their non-cumulative preferred because they don't give you something for nothing. They're giving you a benefit here. No such thing as a free lunch. So they're going to have a little bit lower dividend rate on this particular type of preferred stock. One other type of equity security that you might see on the test, you would see this definitely on a Series 7 test. You might also see it on the SIE exam. They're called American Depository Receipts. American Depository Receipts are investments that represent a foreign stock. That's really what it is. Let's say that there is a Swiss company that's a Swiss chocolate manufacturer. They're a chocolate company in Switzerland, and you want to buy their stock. Could you get on an airplane, fly to Geneva, Switzerland, find a stockbroker that could help you purchase that stock over there and purchase the stock through that stockbroker over there in Geneva, Switzerland? Sure, you could. But how much would that cost you? Had you looked at airfares lately? They're insane. They're crazy, right? I'll bet you that's $800 easy out of Chicago. Maybe less out of New York, but that's a big number you'd have to pay just to fly there to get Geneva. Then you'd have to stay, on a fancy, Swiss chalet and eat the fancy Swiss chocolate and everything over. Well, maybe you'd like to do that, but it would tremendous amount of cost, tremendous amount of effort. Wouldn't it be easier just to find a bank here in the United States who has an office over there in Switzerland that could sell you something that looked like the stock and acted like the stock, but wasn't actually the French stock itself, and you could do it right here in the United States and never have to leave the country? Wouldn't that be easier? Yeah, that's what an American Depository Receipt is. They call them ADRs on the test. ADRs, American Depository Receipts. They represent the shares of a foreign company. So instead of buying the actual Swiss chocolate stock of Swiss Chocolate Incorporated, you're buying an ADR on Swiss Chocolate Incorporated. Now, they offer ADRs between 1 and 10 shares of that stock. So let's say it's 1 to 1. You buy 100 ADRs of that from a bank, an American bank. It's just like owning 100 shares of that foreign stock. So you will have investment risk here. Investment, they own the stock, but you have the investment risk. So if the foreign stock price goes up, your ADR value will go up exactly by the same percentage. But if the foreign stock price goes down, your ADR value will go exactly down by the same percentage. So you do have good old-fashioned investment risk here, just like owning the stock. It actually operates and moves with the stock price of that corporation. But in this case, the bank does own the foreign stock, not you. You don't own that. You own ADRs that the bank is selling to you that represent the foreign stock. So what this does is it facilitates the purchase of foreign stock in the domestic market. The domestic market is the US market. Facilitate means makes it easier. So you'll see it on the test. Facilitates the purchase of foreign stock in the domestic market. That means it makes people here in the United States easier for them to be able to purchase stock of corporations in other countries. This is also a great diversification tool for people. We have people out there who are very well diversified in their investments here in the United States. They have, stocks and they have bonds and they have them tremendously diversified in different industries and different companies, but they have nothing overseas. You need to have a little bit of your money invested overseas, because if you do, it will increase the overall rate of return of your portfolio of investments. So even a conservative investor ought to have about 5% of their investments overseas, because if they do that, they'll be able to increase their overall rate of return of their portfolio of investments. So ADRs are a great way to do that. By the way, if you see ADS on the test, that's an American Depository Share. That's the same thing, but in this case, it'd actually be offered to you by the Swiss chocolate company themselves. So it'd be offered to you by the foreign company here in the United States. Those are called ADSs, American Depository Shares. But most of them out there in the marketplace are the ADRs, the American Depository Receipts, that are offered by American banks. Now, ADRs can pay dividends to people. Let's say that company in Switzerland, the Swiss chocolate company, they pay a dividend. You don't get the dividend because it's paid to the bank. The bank owns the stock, not you. So the bank gets the dividend. And they're probably going to pay those dividends in the currency of that country. It might be the Swiss franc, or it might be the euro, which is the currency that can be used in many different countries over there in Europe. Let's say they're paying out the dividend to this American bank you're working with in Swiss francs. Well, foreign currency moves in the opposite direction of the United States dollar. The US dollar is the benchmark for all the major currencies around the world. We've been doing that since the end of World War II. So it's us against the world. The Swiss franc is measured against the US dollar. The euro is measured against the dollar. The British pound, the Japanese yen, the Australian dollar, all the major currencies are measured against us. So if foreign currency goes down, the US dollar goes up. And if foreign currency goes up, the US dollar would go down against that currency. So what you'd be concerned with here is what they call foreign currency risk. Foreign currency risk is where the value of the Swiss franc goes down against the dollar in the world marketplace. They call that the interbank market. That's where we trade international securities. It goes down in the interbank market against the dollar. They'll pay out a dividend in Swiss francs to the corporation, to the American bank that owns that, stock, and then they take that money, convert it into US dollars, and you lose money on the foreign currency exchange in that situation, because the foreign currency went down against the dollar. You're going to get the Swiss franc is not going to be worth as much as the dollar because it went down. So you'd be concerned about the foreign currency going down in an ADR situation. That's called foreign currency risk. Now, the dividend that you receive, this money that you receive, is taxable in Switzerland. You actually have to do it's sort of like paying taxes in Switzerland. What most countries do around the world is, if you have investments over in their country, they will withhold 15% of your income for tax purposes, which means if your dividend was supposed to be $1,000, you're only going to get $850. The country of Switzerland, the government of Switzerland, withholds $150, and then next year you'll have to file with your United States tax return, your 1040 form, with a foreign, what's called a foreign tax credit, and you get the $150 back next year. So essentially, you're letting the country of Switzerland, the government of Switzerland, use your $150 for a year. You typically don't have voting rights here with ADRs, because again, the bank that you're working with, they own the stock, not you. So they probably are voting the stock where you're not. If they do have stock rights that are given to the stockholders of this company, which would be the bank, a lot of times companies will the bank will just sell those stock rights and give you the money for those too. Again, if they give you that money in the foreign currency and the foreign currency goes down against the dollar, you could have a situation there where you're going to lose money on a foreign currency transaction in that particular case as well. So that's the third type of equity we know they're asking about on the test, equity security, the American depository receipts. So that ends our webinar here today on equity securities. Thank you for using Kaplan. We wish you the best of luck on your test. Stay safe out there, and we wish you all the best going forward.